You're listening to the Option Alpha podcast from OptionAlpha.com, where we show you how to make smarter trades, learn how the stock market really works, and generate consistent monthly income. Now, your host and head trader at OptionAlpha.com, Kirk Duplessis.
Hey everyone, this is Kirk here again at OptionAlpha.com, working every single week to make this the most popular investing podcast offered in iTunes and online because it's based on one thing and one thing only, and that's helping you guys make smarter trades. So thanks so much for tuning in today. We've got a really cool episode today, episode number 30, which is crazy that we've already done 30 episodes, talking about a zero-cost way to protect stock gains with options. So really trying to get back to this whole different mentality and thought process that you should start to be going through, especially if you're new to Option Alpha or if you've been trading for a while, about how options can really benefit just the regular investor, even a general stock position that we're going to look at today, how just using a couple simple option strategies that most people don't really think about can help reduce your risk and still maintain some upside gain potential in the stock and really kind of help protect against possibly a market sell-off or even kind of a mini crash of some kind, okay? So that's really what we're going to be going through today. Just as a heads up, you can always get all of the show notes and any images that we talk about here today, especially some profit and loss diagrams that we're going to show you guys by going to optionalpha.com/show30. That's just the number 30, optionalpha.com/show30. And you can get our free bonus download today, which is our 114 Answer Vault questions that we have as a free PDF download. It's 69 pages of basically just Q&A from our membership. People have sent in hundreds of questions. I've narrowed them down to 114 very specific questions and wrote out long descriptive answers to them. And that's all available in a free PDF download. Again, for you guys today, just go to optionalpha.com/answers and you can grab that free PDF download. So let's get into it today, talking about how we can protect our position. So the first thing that we have to talk about, obviously, is this idea that we're going to basically make the assumption that you have a long stock position. And we'll just say 100 shares to make it round and even. But the whole idea here is that you've got some sort of long stock position that you want to protect. And in most cases, if you're going to be long stock, I mean, you generally understand that it's going to carry some risk that the stock may gap lower or continue to move, lower if the market sells off. So in our case today, what we want to do is help you protect against possibly a little bit of that sell-off, or at least reduce your cost basis on owning that stock by using this certain option strategy that we're going to talk about today. Now, this isn't, of course, going to completely protect you from any stock movement lower. You're still going to be generally long stock, but it's going to, again, help reduce some of the cost basis in doing this. And if you do nothing at all, then you'll obviously be in a worse position than if you do the strategy that we're going to talk about today. Now, I first want to kind of preface this by saying that when you look online, and especially when I was doing a little bit of research for this podcast, and I always like to see what other people say out there, the default answer that most people have, or even some very big prominent financial institutions like MarketWatch and Wall Street Journal and The Street, all of them really talk about buying protection for a stock portfolio in the sense of buying put options. So buying a put option, maybe a couple strikes out of the money, or maybe 10% out of the money. I saw one person say, always buy a put option, 10% out of the money. But the reason that I don't prefer to do that if I have a stock position is that if I'm really bearish on the stock that I want to buy a put position, one, I shouldn't be in the stock to begin with, right? So if you're going to actually physically go out and buy put options to invest more money into the security thinking that it's going to go down, it's really a bad situation because you shouldn't be in that security long stock anyway. If you think it might go down that far or even 10%, maybe you get out and buy back in later when it's 10% lower. But two, it's going to cost you a lot of money to maintain that protection on the portfolio. So one thing I didn't see mentioned a lot of different places is that the running cost, or kind of the maintenance cost of keeping this protection available and working on the portfolio, is going to really start to eat into some of your profits. I mean, we know here at Option Alpha that we like to sell those out of the money options because that's really where we gain our edge in the market, is by selling options. So if we gain our edge in the market by selling options, then it's safe to assume that somebody who's buying those options that are generally far out of the money are going to expire worthless in most cases. And what that means is that if you're a long stock investor and you keep buying these put options, maybe you're spending $150, $200 a month buying protection, at some point that protection is really going to become useless long term, and you're just going to keep shelling out this money. It's like, I always think it's like rent. Like if you pay rent right now, you're just really, shelling out money, and you're paying for somebody else, to have some sort of gain or benefit. It doesn't really serve you any purpose. So in today's podcast, what I want to do is I want to go through a no cost approach that you can use to help give you some downside protection. Okay. And again, it's not going to protect all of it, but it's going to help give you some downside protection, and it doesn't cost any money. So doing this on your position is better than doing nothing. And maybe if you don't want to spend any money buying a put option, it might be a better alternative to doing that. So here's exactly what you need to do to execute this zero cost approach. The first thing that you have to do is you have to combine two different strategies, okay? So this is a really good way to think about options. Is I always like to think about options, especially with hedging, as what am I paying for and what am I getting? And so what am I gonna outlay money for? Because I need to get some sort of protection. What am I getting for that protection? And is there any way that I can finance that protection with some other strategy? So actually, an interview that we did with John Carter, which I believe was episode number 25, we talked about this a lot in our closing bell segment on that show, talking about this concept of using different option strategies to finance some sort of other goal. So in this case, with this zero cost protection strategy, the first thing that we're going to do is we're going to buy an at the money put spread on the stock that we have. So buying that at the money put spread is going to cost us money initially because we're net buying options and we're going to go long a put spread, assuming that the market, again, is going to go down and we want some sort of protection. The other part to this strategy then is to go out of the money on the call side and sell a covered call above the market. Now the goal here is that we're going to take that call that we sold above the market, and hopefully the premium that we took in for that call option is going to more than cover the cost of buying the at the money put. So again, what we're doing is we're using that covered call option to basically facilitate or finance the purchase of our insurance, which is our at the money put spread. Okay. So using these two different strategies, we can in most cases do this for zero cost. In almost every case, you can probably do it for very little cost. We like to do it definitely for zero cost for any of our long stock positions that we have in, say, maybe a retirement account or a SEP account. And then if we can actually do this for a small credit. And doing it for a small credit is just going to increase kind of the break-even points on this strategy. So what we're going to do here is we're going to actually get right into the closing bell, because today's closing bell talks about how we can execute this strategy on an actual example using TLT. So let's get right into it.
Now, the closing bell. Find out which stocks we're looking at right now, trades we're making, and hear our game plan moving forward.
All right, so in today's closing bell, again, like I said, I want to talk about how we can actually execute this strategy in a current, maybe a position that you have. And we're going to use TLT in this case and just assume that we're long 100 shares of stock. So again, this is all going to be archived. We've got a really nice profit and loss diagram that shows this whole deal that you can get at optionalpha.com/show30. But we're going to make the assumption that right now we're going to go long 100 shares of TLT just to give us some sort of long stock position in TLT. But we also want to protect ourselves against a possible move down in bonds or TLT. So right now at the time of this recording, TLT is trading at about 118.50. So if we bought 100 shares of TLT, we'd buy them at a net price of 150. That's exactly, or 118.50, is exactly where the stock is trading right this moment. Now, if the stock moves down, then we obviously lose every single penny that the stock moves down, right? Because we don't have any protection on this. We're kind of naked on this position. We make a lot of money if the stock moves higher, but if it moves down, we have no protection. So this zero cost approach strategy would look something like this on TLT. Again, remember the stock right now is at 118. What we could do is we could buy the 118-117 put spread. So it's just slightly out of the money, but that 118-117 put spread costs us $50. So it costs us $50 to get into that put spread, which gives us a little bit of protection between 118 and 117, gives us a new break-even point that's much lower. Now that's a good strategy to employ because it does give you, again, a little bit of downside protection, but the only drawback to that strategy is that it costs you $50 by itself. So if we didn't do anything else, it would cost us additional money to protect this position. So what we're going to do instead is we're going to go out of the money on the call side, and we're going to sell a 123 strike call option on TLT. Now again, the stock's trading at 118.50 right now. So we're going to sell a 123 call option above the market. So $4 plus out of the money. We're going to sell this 123 call option for $1. So it's trading right now for $1. And so that means that we're going to take in $1, pay 50 cents or $50 to buy or finance that put option or that put spread that we bought, the 118, 117 put spread. That's going to leave us with an extra cushion of 50 cents or $50. So we're going to take in a net credit of $50 in this case. Now you could move your call strike a little bit higher. And so you could move it up to say 125 and you could take in a credit of 50 cents on that call. And that would leave you with a net cost of $0 and just give you a little bit more room on the upside if you really thought that TLT was going to go higher. But again, the whole idea at this point is that we want to protect against possibly a continued move lower. So if we're in the mindset of thinking that it might continue to move lower, we first want to maybe take in as much premium as we could and protect the downside first before we start thinking about the upside. So in our case, we're buying the 118, 117 put spread just below where the market is. That costs $50. And then we're selling the 123 call, which we're going to take in a credit of $100. So the net difference is that we took in a net credit of $50. Now what's really cool is what happens next. Now our break-even point on the actual stock or our cost basis on owning the shares of stock has now reduced down to 117. So it's gone from 118.5 all the way down to 117. And again, notice, like I said in the beginning of the show, it's not that we're completely removing the risk, but for $0 cost, it doesn't cost us a dime to get into this type of strategy. In fact, we're getting paid $50 to get into this strategy. We're reducing the break-even point on our stock position down to 117. Okay, I don't know any other strategy you can use just with stocks that will reduce your break-even point and your cost for absolutely no money out of your pocket. Right? There's nothing else that you can do that will do this. So now our break-even point below the market is 117. And what that means is that we have been able to reduce the cost basis on this stock in just 1 month by a 1.26%. Okay, so if we did this every single month and we never saw any, kind of repercussions on it, we just keep very systematic about how we're doing this, continue to use this $0 cost approach, you could get to the end of the year not spending any money and reduce the cost of owning the stock by more than 12%. Okay, now you can see why this is an effective strategy because it doesn't cost you any money long term and you still reduce the cost basis of owning the stock. Now, what most people say from here is they say, yeah, but you also are giving some upside potential away. And that's definitely true. In options trading, one thing is definitely true above all else, and that is if you give up some of your upside potential, you increase your potential for success. Okay, so I'll say it again. If you give up some of that upside potential in the stock, you increase your potential of success overall. Because by giving up a little bit of upside potential, you are dramatically increasing your success by moving your break-even point lower and your cost of owning the stock lower to 117. Now, in our case, because we sold the 123 calls above the market, that means that we still have an opportunity to earn 3.79% return if the stock goes completely higher, right? If the stock TLT just all of a sudden turns around and shoots through the moon, then we would be capped out at only making the difference between where the stock is now and all the way up to 123. And that leaves us a gain of 3.79% in one single month. And I don't know about you, but annualized, that's a pretty good gain if we can make almost 4% in 1 month with no cost to protect ourselves from the downside. So this is a really good example, and hopefully that made sense. It probably will make a little bit more sense as you go through the actual chart that we have in profit loss diagram on the actual show notes page. Again, optionalpha.com/show30, and you can take a look at this. But the whole idea here, again, is that we're using options in a different mentality. We're thinking about options trading differently. And this whole concept of combining different strategies together and figuring out how we can put these building blocks together to reduce our risk, keep some upside potential, and do everything for $0 cost. So hopefully this is a really cool episode. Please share it with some of your friends or even your financial planner or your stockbroker if you have one. This is a great way to systematically protect your portfolio every single month by doing this strategy, and it doesn't cost you anything out of your pocket. In fact, you could probably make a little bit of money long-term on this if you keep taking in a credit.
Thanks for listening to the Option Alpha podcast. If you liked what you heard, please drop by iTunes and leave a rating or comment. Plus, you can get everything: free email updates for future shows, transcripts, video tutorials, case studies, and more. Just visit our website at optionalpha.com.
All right, so I truly hope you enjoyed today's show and got at least one thing out of it you can apply right now to make you a smarter, more profitable trader and investor. And I hope that you share this show with your financial planner or your stockbroker or anybody else in your family that might be interested in trading, because it's a really cool example of how you can do a zero-cost option strategy to reduce risk in owning stock. Now, as always, you can get additional resources, links mentioned in the show, and we've also thrown in some related video training on this by going to our show notes page at optionalpha.com/show30. And hey, could you do me a favor? If you like this show today, please head over to iTunes and give us a rating. It's honestly the best way to get the show into the hands of those who need it most, and I would be extremely grateful. In fact, I get emails from people every single day saying how much they love the podcast. So take a couple minutes right now, go over to iTunes, give us a review and rating, and let us know how we're doing so that other people can find our show in iTunes. Finally, you can get today's freebie that I mentioned earlier, our 114 different Q&A answers from our membership community by going to optionalpha.com/answers. And until next time, happy trading.